Picture this. A friendly guy in a nice blazer slides a glossy brochure across a coffee shop table and clicks his pen and writes one number on a napkin, $545 a month. He tells you it's a guaranteed way to protect your family and build wealth at the same time. But there is a massive catch hidden behind that brochure. Whole life insurance is actually two completely different financial products stapled together. You get a basic life insurance policy that pays out if you die, and an investment account bolted onto the side. The entire pitch relies on you believing that buying them together as a bundle is a better strategy than doing both jobs separately. Let's run the math to see if that actually holds up. If you are 35 and healthy, you can buy a $500,000 term life policy, meaning pure insurance with no investment piece attached, for roughly $40 a month. If you want that exact same $500,000 of coverage through a whole life policy, your bill suddenly jumps to about $545 a month. You are looking at a $500 difference every single month for the exact same death benefit. The question we have to answer is what you are actually getting for that extra $500. This split screen chart tracks two identical guys over 30 years. We'll call them Marcus A and Marcus B. They both have a budget of $545 a month. Marcus A buys the whole life policy. Marcus B buys the $40 term insurance and drops the remaining $505 into a low-cost index fund. For the first 3 years, 50 to 80% of Marcus A's premiums don't go into his investment account at all. They pay for fees and the salesman's commission, leaving his actual cash value shockingly close to zero. Over on the right side, Marcus B skips the middleman. His entire $505 goes straight into the index fund, where it bypasses those steep commissions and starts earning compound interest immediately. Let's fast forward through the next 3 decades. The cash value inside a typical whole life policy creeps along at about 2 to 3% a year. Meanwhile, historically, a broad U.S. stock market index fund returns somewhere between 7 and 10% annually over long stretches. By year 30, the final numbers are locked in. Marcus A holds roughly $180,000 in cash value. Marcus B, having spent the exact same amount out of pocket each month, ends up with around $590,000. That is a $400,000 gap. It's the literal price of sacrificing compound interest just to keep two simple financial tools stuffed inside one expensive package. Let's rewind the timeline to year 4 and stress test a specific claim the salesmen love to make, that with whole life, you can never lose money. Imagine Marcus loses his job and money gets incredibly tight. If he tries to tap into his cash value, he hits a wall. The fine print reveals you aren't actually withdrawing your money. You are taking out a loan from the insurance company, and they charge you interest to access it. If you die with an outstanding balance on that loan, the company subtracts what you owe from the death benefit before your family sees a dime. The protection you bought gets hollowed out from the inside. If Marcus is out of work and simply cannot scrape together that steep $545 monthly premium, he has to surrender the policy entirely. Because those early years were eaten by fees, he walks away with almost nothing. Researchers at the Wharton School looked into this and coined a blunt term for it: lapse-based insurance. They found that the insurance industry's pricing and profit models actually depend heavily on buyers quitting early and leaving their money behind. A separate study from Columbia Business School highlighted exactly who is quitting. When recessions hit, lower income and economically vulnerable families are by far the most likely to drop their policies and lose those years of premiums. The math here is cruel. A product sold as a financial safety net relies heavily on taxing the exact families who have the least cushion to survive a bad year. There are a few narrow situations where whole life insurance makes mathematical sense. If you have a massive taxable estate, a lifelong special needs dependent, or you have completely maxed out every 401k, Roth, and HSA available to you, permanent coverage has a place. But if you are working an ordinary job and trying to figure out how to best protect your kids, you are almost certainly not the exception. You are the marketing target. The clean answer is to separate the jobs. Buy a cheap term policy to cover the specific decades your family actually depends on your income, and route the money you save directly into an index fund. The next time an advisor pitches you whole life, ask them one question: What is the policy's internal rate of return after fees? And how does it compare to a total market index fund over 30 years? True financial security doesn't come from an expensive bundle. It comes from paying for the exact insurance you need and letting your wealth grow in an account that actually has your name on it.